This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
This video works through question 5 of the June 2010 F8 International Stream Auditing and Assurance paper. As with many questions, this one starts with a very short factual element. Here's simply a definition of what is meant by the going concern assumption. And what you should be able to write here is that a going concern assumption means that management believes that the company will continue in business for the foreseeable future, and the term foreseeable usually means not less than the forthcoming 12 months. The going concern basis is used for drawing up financial statements, and it is assumed that the company is a going concern unless it is in imminent danger of ceasing. Part B is rather more interesting. It's an application question. It asks us to identify any potential indicators that the company is not a going concern and describe why these could impact upon the ability of the company to continue trading on a going concern basis. So this is almost universal in application type questions. Two parts: identify and explain, identify and describe, list and describe, or whatever. You must make sure that you do both parts. Really, identify is easy here. It's the description. It is describing why you think this is going to cause a problem, which is the slightly harder but very vital requirement that you have to meet. If you were just to write down the potential indicators you'd identified, you couldn't get much more than maybe 3 out of 8 marks in this. It's the description which lets the examiner see that you understand what's going on. So let's just read through it, and we'll kind of do rather informally both parts at once. Generally, again, this would be quite good to approach on a columnar basis. One column where you identify the potential indicators, and then opposite that in the second column, your explanation or description as to why these could impact upon the ability of the company to continue to go in concern basis. Okay, so MediMaid Company is an established pharmaceutical company that has for many years generated 90% of its revenue through 2 specific cold and flu remedies. 90% is a potential danger signal. We don't know that it has impact yet on going concern, but it means they could be at some stage at substantial risk if 90% of your income just flows from 2 products. The company has lately seen real growth in the level of competition that it faces in its market, and demand for its products has significantly declined. So here I think we kind of our first real point. You could maybe even divide them into 2 points, but they're essentially around the 1 point. They generate 90% of their revenue from 2 products. For those 2 products, there's been a real growth in the level of competition, and the demand for its products has significantly declined. In other words, demand for 90% of its products has significantly declined. The implications are simply that if you can't make sales, you're not going to get cash coming in. Probably if it's a pharmaceutical company, they have substantial fixed costs in terms of their factory and the salaries of their research teams and so on. And if money doesn't come in, you're going to run out of it. To make matters worse, in the past, the company has not invested sufficiently in new product development. So their current products are declining or have declined, and there is nothing to replace them. Nothing wrong with your current products declining as such, although it's not nice, but if there's nothing to replace them, then you really are in particular difficulty. So this could impact on their going concern, because we cannot see where their revenue or how their revenue is going to increase in the future, how they're going to generate sales to keep the cash coming in. Remember, primarily companies go out of business because they run out of cash, not because simply they don't make profits. The company has been trying to remedy this by recruiting suitably trained scientific staff, but this has proved more difficult than anticipated. So, third bit of kind of bad news. Current products have declined, we have nothing in the pipeline, and now it seems we have no way of getting anything new in the pipeline because we cannot recruit suitably qualified staff. Again, they are simply running out of revenue and with no foreseeable way of replacing those lost revenue streams. In addition to recruiting staff, the company also needed to invest $2 million in plant and machinery. It wanted to borrow this sum but was unable to agree suitable terms with the bank, therefore it used overdraft facility which carried a higher interest rate. Now there's several things going on in here. First of all, it had to invest in $2 million of plant and machinery. It has spent the money, this just soaks up money. It couldn't agree suitable loan terms, therefore it uses overdraft. But an overdraft is repayable on demand. And if the bank were to get worried about the amount and the way it was being handled, they could simply ask for it back tomorrow. There is a higher interest rate, and amongst other things, this means that their suppliers have been paid much later than usual and now have withdrawn credit terms. So they want cash. We mightn't have cash. If we can't supply our suppliers with cash, then they will not provide the raw materials for us, and we will not be able to make our products, even to sell into a diminishing market. The company's overdraft balance has grown substantially, and you'd expect this to be worrying the bank a little bit. The bank is going to be getting quite nervous about this company. And then the proof of it, really, is the directors have produced a cash flow forecast, and this shows a significantly worsening position over the coming 12 months. So we suspected that the cash flows were not going to be great news, and indeed the company has now confirmed that they are in great difficulty on the cash flows over the future 12 months. Even worse, the overdraft facility is due for renewal next month, but we've no idea, we seem to have no indication as to whether or not the bank is going to agree. The bank has seen it going up. The bank will want to see the budgets and the cash flow forecasts. And if I were the bank manager here, I would probably want to get my money back. And real, I think, difficulty coming up when the overdraft facility is up for renewal. Part C asks you to explain the audit procedures that the auditor of MediMaid should perform in assessing whether or not the company is a going concern. 6 marks probably looking for 6 things that you might be doing here. That's the sort of budget to be looking for. The important thing is, however, it is saying that the auditor of MediMaid, okay? These are not general procedures. We have to tailor these to the precise items that have been mentioned in the scenario and what we might do in respect of those. So here is a potential answer to that. We've been told that they have carried out cash flow forecasts. These are bad news, but we can't just take that at face value. The auditor must check everything. And we should therefore obtain the cash flow forecasts, make sure that calculations are arithmetically correct, and we have to review and actually critically question the assumptions that have been made by the directors and discuss those assumptions with management. It's quite difficult to actually assess cash flow forecasts because it's all in the future and so much depends on assumptions about sales and costs and so on, but we need to go into this, as with every part of an audit, with a degree of professional skepticism. It's important for us to try to assess how reliable this forecast is. We should examine the board minutes. Major issues like potential going concern problems, reluctance of the bank to agree terms, reluctance of suppliers to keep supplying us, difficulty in recruiting new staff, discussion about the decline in sales and the stiff competition and so on that we're facing. These are very major issues facing this company, and they should be discussed at board level, and we need to get some insight about what the directors really think is happening there. We should examine correspondence with lawyers. Some suppliers might already have taken legal action. And even though it's kind of going slightly outside the direct information given in the scenario, other than we're told it is a pharmaceutical company, pharmaceutical companies are frequently followed for damages. If somebody claims that pharmaceuticals have caused some sort of injury to them, there may be other issues about going concern in a pharmaceutical company other than just this immediate cash flow one. We should examine correspondence with suppliers. If any suppliers seem to be showing some willingness to reinstate credit terms, then we could perhaps get a breathing space there. It might be indicating that the going concern problems were not quite as harsh, but if the correspondence with suppliers is kind of bad-tempered and suppliers have definitely said no supplies unless paid for by cash, we know we're in some trouble. Examine correspondence with the bank. The bank was earlier reluctant to give us loans. We've had to increase our overdraft. The overdraft is coming up for renewal. If the bank doesn't renew the overdraft, we are in trouble. You'd expect that there would be some initial perhaps discussions with the bank manager, because the overdraft is due for renewal next month. And I don't think we're going to wait until the last week of the current agreement before we go and see the bank manager. If they have said or seem to be indicating they are reluctant to renew facilities or to increase facilities, or they want the facilities decreased, then again we have real going concern problems there. We should look at post-balance sheet results to see how trading in the new financial period is actually progressing. If it seems to be picking up, then maybe the decline in sales has been temporary. Maybe we can see an end of the misery. If, however, the sales seem to be well down or even declining, again, there is a real issue as to where we're going to get the cash coming in from. The directors have said that there'll soon be new product coming on stream. Well, I would like to see some evidence about that. New products in pharmaceuticals have to go through very complex regulatory approval to make sure they're effective, to make sure they're not damaging people. We'd expect to see some sort of degree of progress there. This will all be very carefully documented. You'd expect internally minutes of research committees or discussions with chief scientists and so on to be present. We might go and talk to some of the research staff just to see also how far the new products have actually progressed, to see whether they're going to offer perhaps some degree of rescue pretty soon. And finally, we should obtain written representation from the directors supporting their opinion that the company is a going concern. If the directors are not willing to give this in writing, then why would we ever believe them? We don't necessarily believe them if they do give it in writing, but certainly at the very least you would expect them to sign a letter of representation referring to the going concern matters. In Part D, the auditors have now been informed that Medimaid's bankers will not make a decision on the overdraft facility until after the audit report is completed. The directors have now agreed to include going concern disclosures. The requirement is for you to describe the impact on the report of Medimaid if the auditor believes the company is a going concern, but a material uncertainty exists. So the auditors here are not so uncertain that they think that the financial statements should not be drawn up on a going concern basis. They're saying that's still an appropriate basis, but it's going to be important that proper disclosures are made to the members of the company about the uncertainty which exists. So here is, broadly speaking, what the answer is going to be looking like. If there is proper disclosure by the directors in a note to the accounts, in other words, a note explaining that there are these going concern uncertainties, that there are material uncertainties in this respect, if proper disclosure is made by a note, then the accounts are as good as they can be. The accounts are as perfect as they can be, and in such a case, the auditors cannot modify their opinion. They may change the report slightly to make sure that the members don't overlook this note, and that's then an emphasis of matter. So, if proper disclosure by the directors is made in a note, then an emphasis of matter paragraph will be included after the audit opinion and cross-referenced to the note. This is not a modified opinion. So financial statements are still fairly presented or still show a true and fair view. The purpose of the emphasis of matter is to make sure that the members don't overlook this important note. If the disclosure is judged to be inadequate, so the directors have said something about maybe going concern, but maybe they put the wrong, perhaps spin on it or something of that sort. If the auditors feel a disclosure is inadequate, then the financial statements are not kind of perfect. They do not show a pure, true and fair view, or are not perfectly, fairly presented, and then the opinion must be modified. The auditors have a criticism of the financial statements, and the opinion must be modified either by an except for phrase relating to a material misstatement in the financial statements, or by an adverse opinion that the accounts or the financial statements do not show a true and fair view or are not fairly presented because of a material misstatement. Effectively, in both of these situations, the material misstatement is that the accounts do not disclose properly the material uncertainty surrounding the issue of going concern.